Thanks. Hello, everyone. As Ken said, I've been involved in the community capital world for quite a while. Kind of what brings me to this particular topic, and I have a particular, just a very deep interest in helping more people learn how to invest where their hearts and homes are. This interest grew out of my work starting one of the first equity crowdfunding platforms in the country before the Jobs Act went into effect and allowed for regulation crowdfunding. My co-founder Louisa Shibley and I started an intrastate crowdfunding platform that allowed Vermonters to invest directly into Vermont businesses. And one of the things that we learned through that experience, we kind of knew going into it and learned as we went along that there is there's a lot to learn for individuals who are starting to make direct local investments on their own. This is a whole new world to learn about. And so I've been working a lot in this field, and happy to have so many folks here wanting to learn more about it. So without further ado, I'm going to start up. Oh, first of all, I'll share my screen. And here we go. All right, so first one big caveat is I am not a registered investment advisor. So if you came here looking for investment advice on particular investments, that kind of thing, I am not here to give that, but I have a feeling that's probably not what you're here for. But just wanted to put that out there. I have been an accredited investment advisor in my past, but that was a long time ago. But I'm still very much interested in this world and pretty deeply immersed into it. There we go. Second caveat is I want to start off, first of all, by talking about accreditation and the concept of an accredited investor. The rough definition set up by the SEC is an individual or a married couple with a net worth of $1 million, excluding their primary residence, and or an individual income of $200,000 for the past 2 years and a reasonable expectation that you will continue that income into the future, or $300,000 for combined with a spouse. So those are the criteria for being an accredited investor. And what it means is that really just a handful of Americans, only about 5%, a little less than 5% of Americans actually meet that criteria for being an accredited investor. What being accredited allows you, or has allowed you for quite a long time, is the ability to make direct local investments. In other words, being able to direct in what's considered private securities, and those are any securities that are not offered on a public stock exchange, like the New York Stock Exchange, the NASDAQ, that kind of thing. So for the rest of us, our investment opportunities have mostly been in the realm of these publicly traded securities, stocks, bonds, mutual funds. Now, thanks to regulation crowdfunding, that has opened the doors and allowed for a lot more opportunities for unaccredited Americans to start making investments into privately offered securities. And that's what we're here to talk about today. So another caveat, though, is that about 83% of all of the savings that we all have in the US is mostly in our retirement accounts. So our 401ks, 403bs, and IRAs, traditional IRAs. And again, through the regulations that are in place through the SEC, ERISA, and the Investment Company Act of 1940, all of these things together limit how an individual can invest their retirement savings if the majority of your retirement savings is in one of these qualified retirement plans. Qualified meaning it is it is set up under the regulations. of the powers that be down in Washington, in one of these forms, you can only invest those retirement savings, again, into publicly traded securities only. Definitely with 401k and 403bs, your only option for investment is into a publicly traded security. With IRAs, there is a version of an individual retirement account that is starting to gain some popularity and some traction. It's called a self-directed IRA. It takes some special registration. It requires finding a custodian, which is an organization that is set up and duly licensed to house your self-directed IRA and to administer it, and any investments that you make have to be funneled through this, through whatever custodian you have, and some have more onerous paperwork than others for being able to make investments. But what a self-directed IRA allows you to do, it does give you the opportunity to invest in securities or in businesses or things like that that are not publicly traded companies, not your typical stock, bonds, and mutual funds. So a self-directed IRA is starting to give the opportunity for people to take their retirement savings and direct it into direct local investments. Another corollary with that is something called a solo 401k, which is open to self-employed people. They can set up basically what, it's structured similarly along the lines of a 401k. It allows self-employed people to actually, the amounts that you're allowed to put into your solo 401k are much higher than what you could do for a self-directed IRA. So it's a very appealing structure for self-employed people to be able to put money into their retirement savings. And again, a solo 401k, if properly set up, can make investments into private local investment opportunities. Michael Schumann, who many of you may know or have heard of, has a book coming out very soon this spring called Put Your Money Where Your Life Is. And he's talking specifically about how to set up self-directed IRAs and solo 401ks so that we can all learn how to do more of this and direct more of our retirement savings into structures that allow us to invest the way we like to invest according to our values. Because as you can see from this stat, that's where most of us unaccredited folks in the country, that's where we keep our money. But with that being said, there's still that 17% that's not in retirement accounts, and that's it's no small change. It works out by some calculations to around $11 trillion, a lot of which is sitting in savings accounts, money market funds, certificates of deposit, and then also into direct investments into mutual funds or stocks, bonds, mutual funds that are not specifically under the auspices of your retirement account. So, we still have right now the ability to direct some of our savings into direct local investments. So let's talk about how to do that. Now, when we think about kind of the landscape, when we think about our investment, I've had a lot of interesting conversations with folks over the years, and noticed that a lot of times we tend to think of our money our disposable income, if you will, besides what you need to maintain your lifestyle. We think of it in two buckets. We have our investments and we have our philanthropy. And I thought it might be interesting to kind of graph this out in terms of what our expectations are in the current market for those two buckets of money. And so I laid them out on a grid of financial return on investment and social return on investment. Now, most traditional investment types, the big banks, as I said, all of our retirement savings, which has to go into publicly traded securities. Mutual funds are mostly publicly traded securities. And of course, things like angel and venture capital are less focused on the social return on investment that you would get from these securities, and really more focused on that maximizing your financial ROI, especially the retirement savings, mutual funds, and other investments that we make. That's kind of what we've been conditioned to be seeking, is a maximization of personal financial ROI, less about social return on investment. Now, it's not that black and white, of course. Things like impact investing, which has, that term's been around now for about 10 years, and the practice has been around a little bit longer. And in some cases, used to be known as socially responsible investing. Even what we're starting to see now from philanthropic organizations with their program-related investing is starting to blur the lines and starting to get us thinking about both the social returns that we want to see on our investment, while we're also hoping to gain some financial ROI. So this is a trend in a really positive direction. And now that we're beginning to see more opportunities to draw our investments more toward the center of this chart. And ideally what we want to see are those that can deliver a high social return on investment while also providing a decent financial ROI. But a lot of what we want to start thinking about as individual investors is kind of what that means for us. But before I get into that, just a couple words here on the opportunities that are opening up through new innovations in community capital, are these bubbles that we start to see popping up with the higher social ROI and offering the opportunity for a financial ROI. Things like local banks and credit unions, often we see that the interest rates offered on savings accounts and share accounts at credit unions and locally owned banks can be higher than in traditional banks. So giving you better personal return, while they're also focused much more than the big banks in the country, focus much more on local investing, especially small business lending, whereas big banks really do little to none of that. Community loan funds that have, this structure, the Community Development Financial Institution, about half of CDFIs in the country are set up as community loan funds. And not all of those allow for individual investors, but many of them are starting to, and there are some that do. And some great examples of those are New Hampshire Community Loan Fund, Vermont Community Loan Fund, Northern California Community Loan Fund, BizWorks, I believe, is one. I think that's the name of the one down in North Carolina. We're starting to see that these being considered as investment opportunities. It's a great way to begin your social and community capital investment path. And then, of course, we have all of the opportunities that are starting to open up and explode with the direct local investment. So first, before we get started, I think it's important, as you are considering making investments, community capital investments, is think about, what does community mean for you? Is it geographic? Does it relate to your town or your county, your state? Thinking through what kind of impact do you want to have with your investments from a geographic standpoint? You might also have what I call kind of an affinity or a cause-related impact, and that's this couple down here at the bottom, the two farmers. Maybe that's something that's a particular interest to you, is supporting small local farms and helping more young people get into the into farming as a way of life. And so maybe community for you can also be about, community is defined as investing in farmers, whether that is in your home state or, you know, somebody in New York City might have a really real affinity with investing in farmers. So probably not a whole lot of farmers in the middle of Manhattan. So for them, it might mean finding opportunities in upstate New York to invest in farms there, so that they know that the farms there are providing the food that's going to make its way back down to them to Manhattan. So really thinking through that. And another way to think about community is how you want to be involved with investing. Is this something that you want to do on your own? Is it something you'd like to join together with others, either through an informal investing club where maybe you meet together to talk about deals that each other are finding, up to things that are even more formal, as in an actual investment club where you would pool money together with other investors and invest together as a group. So, you know, thinking through what expectations you have around community as it pertains to the actual act of investing. So once we've gotten kind of those things that we're thinking about, now it's time to start really thinking about how we're going to make these investments. One thing that, you know, many savvy investors know is the idea of asset allocation and diversification. And so you can diversify, think about that diversification of your portfolio as it relates to community investments also. And one of the exciting things about community investments is that the types of securities that are being offered actually offer, in many cases, greater opportunities for diversification, at least in the terms of the way that you invest. Greater diversification versus just kind of the traditional investments, which are stock, bonds, and, you know, mutual funds, which are kind of a form of stock ownership or shareholding. So these, I wanted to go through each of these different types of securities, and we can, it'll be helpful in the end. I'm going to leave plenty of time for Q&A. If you are looking at particular investment opportunities and have questions about how these deals are structured, I wanted to give a little bit of a primer on each of them here so that you can better understand when and why the different securities are appropriate for different types of investment. So let's start. The top two are the ones that pretty much everyone already knows: debt and equity. Debt being a loan, equity typically taking the form of shareholder, some kind of stock ownership. These are what we see in the traditional market, but we also see them used quite often in, I wouldn't call it necessarily the community capital opportunities, but often in direct local investments, so private placements, private investments into privately held companies. You might see it done in the form of a loan, more often in the form of equity. One of the reasons I wanted to put these up here is just to give us some bookends to a spectrum. If you think about the risk reward continuum, debt is typically seen as lower risk because your return on your investment is well defined. There's a set interest rate, there's a set repayment period. Usually the payments are defined, so you have a very good idea of how you will be getting that return on your investment because it can be laid out in a loan amortization schedule. So you'll know the when and the how much. With equity, that's on the other end of the risk reward spectrum. It's considered higher risk because precisely because its return is unknowable and undefined. Typically what you see with equity is the way you return, or the way you receive your return on investment is when a company is sold or perhaps merged with another company, but there's some kind of what's called a liquidity event, and it often involves a transfer of ownership of the company. Usually it often means when the founder is perhaps moving on and they've sold their company, and the returns, or the money that's received through the sale of that company is then returned out to all the investors. And it really depends, how much you get depends on how big the company is and how much you sell it for. So it's much less defined, but one thing that many investors like about it is that it does have this what's called unlimited upside potential. It also means that you could end up with nothing, unlike debt, where it's often secured by an asset. Equity is unsecured, and so it does have that higher risk, but you have the higher opportunity for reward. Now, with community capital type investments, ones where we are trying to invest in businesses that we believe are going to really be strong economic drivers in our community. That's a lot of times why we're investing in community capital, is to support businesses that have long-term growth potential within a community. It's going to create jobs within a community. It's going to deliver goods and services that are good for that community, and do all of this in a way that keeps that ideally the business owners are running their business in accordance with being a good corporate citizen. So we have kind of different expectations around these types of investments. So to use a traditional security like equity for a community capital investment can often lead to an undesirable end. Meaning, the only way, if you're investing in a small business and you're investing in equity, you're becoming a shareholder of that company. Typically it means the way you're going to get your money back is if the company is sold, and that's not always aligned with what we want community capital to do. We don't necessarily want it to be setting businesses on the pathway towards acquisition and possibly being moved out of our community. It's no longer a community investment at that point. And that's why we're starting to see the use of different types of securities. Convertible notes is probably the most often used type of security for direct local investments and for community capital type investments. And even though it's called a convertible note and it is structured somewhat like debt, all of these other securities at the bottom of the list, I would put in the category of being equity-like, or some people call them near equity type securities. And it's because, unlike debt, where you have, you often have some kind of collateral. It's secured by, the note is often secured by collateral, and has a very defined repayment schedule. All of these are much more open in terms of how you receive your return, and they are all unsecured. So let's talk a little bit about convertible note. The way this works is, it's like I said, it is structured in essence as a loan with a few key features. First of all, the repayment period is typically put off for anywhere from 3 to 5. I have seen 7, but it's usually 3 to 5 years. I call this the grace period. So the investment comes in, the business owner receives that investment and has 3 years, let's say that's the term, 3 years to devote all of their time and capital toward building the business. And a lot of times what we see with convertible notes is that during that time, interest will accrue, but it's not being paid. So it's really giving some breathing space to the business owner, the entrepreneur, to focus their time, effort, and capital on building the business. And then at the end of the 3 years, theoretically, they've grown the business to a point where it's much better established, it's got a more consistent cash flow, and is showing some profitability, so that at that point, it's in a better place to be able to repay the loan. The convertible piece refers to the opportunity at the end of that 3-year grace period to convert the loan into some other form of security. These are used a lot by angel and venture capital investors for really early stage companies. And what they'll do at the end of 3 years is that they'll convert into equity. So, what this allows you to do is to say, okay, we've given you the 3 years to invest to grow your business. And if you're really, kind of firing on all cylinders and the company's doing really well, maybe, I'll be able to get a better return if I convert into equity rather than just taking, my loan payments at, maybe 6%. So it gives the investor this opportunity to convert into another type of security that lets them participate if the company is particularly successful. One thing that I'm trying to work on with more folks as they're thinking about convertible notes is, because I mentioned, equity is not always what the best type of security for the kinds of businesses that we're investing in, because again, we don't want to put them down the path towards acquisition or selling and leaving our community. So instead of converting into equity, we're starting to see more where convertible notes might convert into a royalty or a revenue share agreement. So what a royalty agreement is, it's very similar to what you might think of, for books, book sales. Authors get a royalty on every book that's sold, which is basically just a percentage of the selling price. This is similar along the same lines, and more often than not, the way we see royalty used is as a revenue share agreement. A revenue share simply means that the company agrees to pay a percentage of its revenue on, usually I see this on a quarterly basis, back to the investor until a certain target is met. Now, there are a number of different ways to set up a royalty or a revenue share agreement, and they can actually get kind of complex. I'm going to give you a very simple and straightforward explanation of one, but just know that there's lots of ways that you can add bells and whistles to these to meet certain needs. But I'm going to, just for illustration purposes, give you the most simple example. So with a revenue share agreement, as I said, the business owner would pay, let's say, it's 6% of revenue on a quarterly basis back to their investors, and that they've agreed ahead of time. This would all be spelled out in the offering documents that everyone signs as they enter into the agreement, that once the payment of those royalty, once the total of those royalty payments reaches a certain amount, say it's 6% of the original investment, or I more often I've seen maybe closer to 10% of the original investment, then the agreement is over, and the investor has received their payback, and the business owner is relieved of the commitment to repay, and everyone moves on. So, yeah, to try to sum that up, I know I probably could have shown you a lot of charts and numbers with all of this, but the basic gist of it is that it gives the investor the opportunity to participate in the strong growth of a company. And while the return is fixed, say we cap it at 10%. So let's use some numbers. So let's say I invest $10,000, and when the company starts repaying, they're going to repay a percentage of their revenue back to me until I receive 10%. So until I get 10% on top of my original $10,000 investment, at which case it's done. So the benefit to me, the kind of the way the upside potential to me, the investor, is how quickly that is repaid to me. This is the twist on a revenue share versus a loan. Because you're paying a percentage of revenue, if the company's doing really well and kind of exceeding expectations, the payback to the investor will happen faster than it would if it were a typical loan. So if you consider the time value of money, if I make a $10,000 investment in a company that's going to pay me, it will pay me interest that would equal 10% of my investment over a fixed period of time, say, a traditional loan that would take, 6 years to get repaid. With a revenue share agreement, I stand to perhaps get that same 10% return, but maybe in only 3 or 4 years, because the company is paying a percentage of their revenue as their revenues are going up. So that's the benefit to the investor. The benefit to businesses with this type of arrangement is, again, that it's a way for the company to receive capital without having to lock into an equity agreement and be looking down the road to potential acquisition at some point. So revenue share it's a model that we're starting to see being used more often. I tried to make it as simple as possible. The paperwork on it actually is pretty complex, and you'll need an attorney to draw it up for you, and probably a financial advisor to help explain it to you. But it's a great opportunity for investors to give capital in a form that is really workable and helps to drive long-term outcomes and long-term investment and long-term business planning without having to lead towards a business having to sell out. And if you have questions, feel free to plop them into the chat section, and Ken's monitoring the chat. If there's anything that needs explanation now, we can always get to it at the end.
Since you mentioned it, Janice, there is a question that came into the chat. It came in while you were talking about convertible notes, and the question is, what happens if the business is not making any money at the end of the repayment period? If the person who asked that question wants to refine their question, by all means, feel free to take yourself off mute and chime in. Or Janice, do you feel like you have enough information to address that question?
So what happens if the company isn't making enough money at the end of the grace period?
I assume at the end of the grace period, yeah, the end of the original, yeah. Yeah,
I know. Well, let's step back first and say, what if the company? So when you are setting up a convertible note arrangement and looking 3 years ahead, typically you are starting to define what expectations are at the end, of that 3 year period. You've got the business that should have done a 3-year financial projection, so you have an idea of what they're expecting to do. And so when you get close to that conversion period, that's when you would come back together with the business owner and look at where they are versus where they said they were going to be. If they're growing, on track or maybe better, maybe that's what leads to a conversion. If not, maybe is wise just to stick with the loan arrangement, which is typically at a lower percentage rate than what a revenue share or royalty agreement would be. So a little less burdensome to the business, but yet providing a return. And there are cases where perhaps the business is not doing as well as expected. And what you can do at that point, I mean, they are legally required to pay back that loan. That's part of what the agreement is set up to lay out is that they are agreeing that at the end of 3 years, they're either going to start paying back that loan or the investment will convert into something else. With that being said, there are ways to renegotiate payment terms and that kind of thing. It will involve getting attorneys involved, which is a cost in and of itself, but it is possible to renegotiate the terms of those deals. But it's, so that's usually not ideal, but there is a way to do that. And there is the risk that, the company could fold before the end of those 3 years, and convertible notes are typically unsecured. And so there's no recourse then back to the investor, and basically you would lose all your money in that situation. So there is risk involved with the convertible note structure. It is different from the traditional loan type that has some kind of collateral that's secured to the loan that gives some guarantee that the business will be able to repay the loan. Convertible notes do not carry that. That's why they tend to offer a higher interest rate than perhaps a typical loan, because they do carry that risk. So hopefully that answered that question. Okay, in the interest of time, I'm going to move on to a last of these two, and then we can open it up to more questions. Recoverable grants and safes are two things that are really still very new. Convertible notes structure, we've seen that around for quite a while, maybe, I don't even know how long, but I was using them 10 years ago, and I know they were around longer than that. Royalty and revenue share has also been around for quite a while. Recoverable grants and safes, though, are new things that are coming out. Recoverable grants, more in the community capital world, is where we would hear about those, and they're typically thought of as coming from a philanthropic organization. However, they can also be used by individual investors, and the way to think about them is that, like a grant that would be given to a nonprofit, or a grant could even be given to a business, to a for-profit business, there are typically no expectations for any repayment of that grant. It doesn't mean there aren't expectations that go along with the grant. Usually there are performance expectations a lot of times that go along with those, but there's no expectation that that grant will be repaid. With a recoverable grant, what it offers up, similar to the convertible note, is a feature where you can build in a milestone or a set of milestones that, if a company achieves certain milestones, at that point, the grant would be revisited as perhaps converting into some kind of repayable structure. And milestones can be anything from 12 consecutive months of profitability, or hitting $1 million in revenue, or opening a new chain, or a new restaurant in the chain of restaurants. You can pretty much set whatever kind of milestone you want, but the idea is that the money is given in the spirit of helping a business get the capital it needs to get up and running. And when a business is successful, that it then in essence is showing its gratitude for that early trust through the grant, of receiving a grant, and repaying some or all of the granted money. It's, the terms of it are very much open to interpretation. I do have a template for a recoverable grant that can help people if this is something you're thinking of. It's really it depends on where you're coming from in terms of your personal financial expectations and your motivations. It's great for investors who truly want to provide that true seed capital to a business, to maybe something that is so early stage they haven't even made their first prototype, but they just need some capital to get up and running. It could flop and be gone tomorrow, or it could take off and really be something great. But it removes the onus of repayment, either of a loan or even of a convertible note, because as we said, thank you for that question before, because that demonstrates that there is that legal expectation that the note will be repaid or converted into another equity or into another security. With a recoverable grant, the expectation is really, really much lower. So it's an interesting development. It's being used sparingly, but I do see it here and there. And so it's just something interesting to think about. SAFE, on the other hand, is an acronym, and I'm sorry, I should have written it out for you, but SAFE stands for a simple agreement for future equity. In a way, it's a variation on a convertible note, and it grew out of an accelerator called Y Combinator out in Silicon Valley, and it really was created for Silicon Valley type investments. It's meant to be a much simpler arrangement than the convertible note, hence its name, a simple agreement for future equity. So like a convertible note that would convert into equity, that's basically what a SAFE is doing, but just with a lot less paperwork. Jury's kind of out on the use of SAFEs. They tend to be more favorable to the entrepreneur and the business owner. I've heard many investors, or I've read articles that saying many investors don't want to take them because just the way that there's lots of room for interpretation of what that future equity, like when it would kick into future equity. And so it's, in some ways, I think maybe it's been made too simple and doesn't have enough definition in it, and which is leading many people to stay away from the SAFE. So those are kind of what's out there now. One of the things that I'm working on is thinking through the way we structure investments to be, to see if there is, is there something else out there? Is there another structure that we could be using specifically for community capital that presents a more balanced approach to the investing relationship and considers both the needs and expectations of the investor and the underlying business, and is set up in such a way that it allows for a return, but does not require a business to take steps such as selling out to be able to achieve that return on investment. So still work to be done there, but with between convertible notes and revenue share agreements and the use of recoverable grants, I think we'll start to see some more creativity coming up in the types of securities that are offered. So let's see how much time we have. Okay, I'll not spend a lot of time on this, but
can I interject? And before we move into this slide, really,
yes.
just point out that a question came in from Michelle Greenwood. Hi, Michelle. When recoverable grants are granted to for-profit businesses, is this through a fiscal sponsorship, avoiding tax, or directly to the business?
Directly to the business. That's a great question. So there is no tax benefit to recoverable grants made to a for-profit business. So that is something else to keep in to keep in mind, is that it is truly it on that chart that I showed before, it leans a lot more toward philanthropy than it does toward a financial investment. So it's more like philanthropy with the possibility of maybe getting your money back. And that's another important distinction to make too, is that with a recoverable grant, typically the expectation is that the grant will be repaid, but no additional interest or anything on top of it. So it would just be a repayment of the original investment. Okay. So if we've reached this point and you're still thinking about making direct local investments, which I hope you are, one of the things I want to talk about is the notion of due diligence. And this due diligence is really just, looking into the actual business itself to figure out, is this a good investment for me? So I've broken it down into 6 steps, which some are easier than others, but they're really, it kind of brings it down to common sense, because a lot of times this is what investment, if we're making investments to try to improve the economic situation in our communities as well as for ourselves, we're not looking to make a killing on something. We're looking to find those businesses that are going to add to our communities in terms of their business operations, as well as what they make. So these are the steps that I've laid out, and I've laid them out in this order on purpose, starting with, who are you? This refers to the management team. Who are the people who are running the company? Taking a good look at the management team. Is it a solo entrepreneur? Do they have partners? If it's a solo entrepreneur, have they built a good team around them? Do you trust them? Do they feel like they know what they're talking about? And do you see a wholeness to the management team in terms of the types of skills that they need to bring to the table to run this business? An example of what I see a lot when I've been doing due diligence on companies is great expertise in product development and ideation, even marketing, but a lot of times what's missing is the sales function. The sales function that's a hard position to fill sometimes, but it's one that's so critical. So really, that's what that first question is getting at, is looking at the team and their skill set, what might be missing, how it could be filled, and how you feel about them in general. After you know who they are, what is it they do? What's their product proposition or their service proposition? It's something that should make sense. It's something, again, you don't necessarily have to be an expert in an industry to understand the product proposition of a company. It should be something that makes relative sense, that I can see, I can see what they're talking about. I understand what they're talking about. And in either talking with them or reviewing their business plan, you get a good sense that they have an understanding of their market, who their target audience is, how big the market is, and their competitors, and then where they fit within it. The next one, why do you do it, I think is one of the most important pieces. After you get a sense of who they are and what they're doing, what's motivating them? What is their mission? Is their mission a social mission that aligns with your personal values and what you're trying to support? So really getting into the value proposition of the company, and how deeply is it baked into what the company does. Then we start to get a little bit more into the actual business evaluation. Who's going to want the product or service? Are there enough of them out there? And how will the company get it to them? So this is the sales and distribution strategy. And then finally, the last question is, how does the company make money? Now, I put that question at the end for a reason. And this is very different from what anyone who has done any angel investing probably knows this, or every angel investor or venture capital investor that I've ever known, when they get a business plan, they flip straight to the financial section and start looking at the numbers right away. I put this at the end, and I put it there for a reason. For the community capital investor, if a company doesn't pass muster in questions 1 through 5, you don't even have to worry about doing the financial evaluation, which is often the hardest piece to do. So save yourself a lot of time and angst if financial evaluation is not something you necessarily look forward to, by using the first 5 questions as your initial screens, any company that makes it successfully through those 5 questions, then you can start looking into how the company makes money. Now, notice I said, how do you make money, not how much money are you going to make? Because again, this is about looking at the financial health of the company as it stands currently and where it's going into the future. Have they, looking at their sales projections, the pricing they're planning to charge, and so the pricing and the number that they're planning to sell turns into revenues. And then how much does it cost to actually build the whatever widgets they're selling, and how much does it cost to run the basic underlying business? And at the end of the day, is there any money left? These are the kinds of screens, financial screens, that you want to start putting a company through before you make an investment. Now, with that being said, you might also want to engage the services of a financial advisor to help you go a little bit deeper into all of this. But you can, even someone who does not consider themselves a financial whiz, can make a general financial assessment of a company just by thinking through, what are they saying they're going to do with their growth. Taking a look at if they've been in business for 2 years and their average sales have been around $500,000 each year, and then all of a sudden they say they're going to take in $100,000 of investment in the next year and be selling $3 million. You want to just kind of give yourself a little gut check. Does that make sense? Does that hold water? So looking for the common sense ways to interpret the numbers can help you get an idea of the underlying financial health. But like I said, get the help of a financial advisor if you can, or this is also why banding together into a group to do due diligence together is a great idea, because chances are someone within your group will have some financial acumen that can do a little bit deeper analysis on the investment, and you can all benefit from that together. So at that point, I think we're getting kind of late and I want to leave it open. I did want to just at least give a little shout out for some places to find opportunities. And Ken's going to send out this presentation, and these are all linked. So you can check out, like Investibule, great place to find, if it's going to pull up, there we go. A great place to find investments according to that, as we talked about, your community. You can find it geographically. You can find it by your affinity with certain types of businesses. And you can even find it by the types of investment that's offered. So Investibule is a great place to find investments that are being offered on different platforms. I've also, the Opportunity Finance Network, this is a CDFI finder if you're looking for charitable loan funds or other CDFIs in your region. And then banklocal.info helps you find local banks and credit unions in your region. All right, I will stop there and open it up for questions. Let's see. Oh, come on, I didn't answer all the questions. I know that's not true.
Maybe I'll just step in and first of all, thank you, Janice. It's a lot to digest. And maybe ask a sort of a general question about a lot of times when folks talk with financial advisors, they get sort of a advice about what their portfolio makeup should look like in terms of debt and equity and those kinds of things. And any thoughts you have on, as people sort of think about including some local investments in their portfolio, sort of some general consideration, sort of above and beyond the details of how the different instruments work, just kind of, should I think about debt? Should I think about equity? What are the kind of driving, guiding things to keep in mind there?
Yeah, I like to think of of local investments as just another way to diversify your portfolio. If you're thinking of, a lot, like especially around equity type investments, when you think of, you've got your small cap and your large cap and your growth, all of these kinds of different ways to diversify your portfolio. Local investments are just another way to do that. They'll tend to be higher risk, and this is regardless of whether you're investing in a loan or, in the form of a loan, equity, convertible note, what have you. All of those, it's going to be tend toward the riskier side anyways. And so it's a way to introduce that kind of opportunity into to further diversify your portfolio. Sorry, just lost the train of thought there. But does that get at what you were asking?
Yeah, I mean, I guess I was also wondering about too, and maybe this, you made this point earlier, but liquidity is obviously an important consideration, and I was thinking about that as a central sort of consideration for whether to look for debt or equity opportunities.
Yeah, and that's where and revenue share is, I think that's one of the reasons why revenue share is gaining in popularity. Since a lot of direct local investments don't tend to take the form of debt, they have been in the form of equity, that revenue share is a way to get at the liquidity piece because it offers a new structure for repayment of a loan and a slightly more defined than traditional equity. So it does get at that issue of liquidity for sure. Another, I was just talking on the phone with someone this morning about some new developments with investment funds, community investment funds, which I am a big fan of, as you know, and others might know. This one in particular is a real estate investment trust, and doing some really cool things that, again, is starting to address the issue, kind of a barrier that many investment advisors have that they like to put up to keep their, or to just to counsel their folks away from direct local investments, is the liquidity piece. And so we're starting to see that being addressed more.
Cool.
I see a question, or I want to put a plug in here for solo 401ks for any single entity or owners. Extremely flexible. Yes. Thank you to
Chuck.
Chuck.
Yes. Hi, Chuck.
Yeah, we talked about those a little bit at the beginning, but absolutely, solo 401ks and self-directed IRAs, I think, are going to be really important developments in being able to funnel more capital into community capital investments, because, as I said at the beginning, 83% of our savings is in our retirement accounts, and yet it's locked, right now it's locked into only publicly traded securities. So the more that we can direct our retirement savings into self-directed IRAs and solo 401ks, the more it opens up the opportunity for direct local investments.
Cool. I should also, in the spirit of putting in plugs, I should also mention here that in case you haven't caught wind of this through our newsletter or our other announcements to members that we've been sending out, we are very interested in cultivating communities of practice around both geographic areas and particular kinds of community capital practices. I haven't mentioned in the information I've sent out the possibility of developing a community of practice around retirement fund opportunities, solo 401ks in particular. But if you have interest in that, in convening groups of NC3 members to discuss those kinds of opportunities, by all means, let us know. My email address is nc3@comcap.us, and never be shy about reaching out to me. And real estate investment opportunities are also sort of high in the list of topics that folks seem to be interested in and are reaching out to me about. And it looks likely we'll be developing a community practice around in that area as well. So yeah, and there are, like Janice just said, different ways to go about that in terms of funds or even in direct investment opportunities. There are a lot more and more coming online all the time, and with different kinds of offerings as well. From cooperative sorts of offerings that we haven't discussed quite today, but that can allow an equity share with a dividend return, as well as some of the other instruments that Janice mentioned. So I'm not seeing other chat questions rolling in. Thank you again, Janice. Thank you everybody for joining us today. Oh, there is one.
Oh yes, yes. Crowdfunding. Crowdfunding is a great way to find direct local investments. And there were so many that I couldn't put them all up there. I had a slide that had a whole lot of them up there, and actually I could probably add that back in. Next Seed, WeFunder, Crowdfund Main Street is a great one, and Vestibule, and Milk Money is starting to do more. So finding crowdfunding platforms are a great way to find direct local investments, and often they will add in some help with due diligence. They're doing some due diligence on their own often, which aids in yours. But in the end, it's your decision to make whether to invest or not. So that's, I think, a great way to think about the crowdfunding platforms, is to think through all of these things that we've just talked about here before going out and looking for investment opportunities. Yeah. Thanks, Michelle.
So, I should chime in about crowdfunding a couple things. Number one is next Wednesday, Bill Houston, who's an NC3 board member and a crowdfunding expert, is going to conduct a webinar, Introduction to Crowdfunding, more from the practitioner standpoint about how to run a good crowdfunding campaign. We also are in touch with a lot of the folks who are hosting platforms, and they've been interested in engaging with folks in the NC3 community, and we are working with WeFunder in particular and putting together a webinar. I think we've penciled in March 25th as a date for a webinar with them, to kind of discuss their approach, why they've chosen the approach they've chosen, and others. Honeycomb Credit I've spoken with, Mainvest also out of Massachusetts. And I should point out too, I along the lines of the variety of opportunities, types of opportunities that Janice talked about, different platforms seem to be focusing on different kinds of offerings. And Mainvest in particular is really interested, for instance, in revenue share agreements. And so my hope is to have folks from different platforms speaking through our webinars to folks to learn about, the different more about the different particular offerings and sort of the pros and cons of them, and why particular platforms have chosen to go with particular kinds of deals.
Yeah, and kinds of deals, and sometimes even the types of companies that they'll represent. Another one that I just thought of is Raise Green, that is focusing on crowdfunding for renewable energy projects. So it's a great way, as you think about what is your community and what are you trying to invest in. If you're thinking beyond just a geographic community, but you really want to support green energy, there's Raise Green. If you want to really support farmers, you can find Iroquois Valley Farms. So getting clear on kind of what it is that you want, what's the impact that you want to make in the world with your investments. There is a growing number of ways to find investments along those lines. And so just do it with, get ready for your due diligence and get your checkbook out.
And like I said earlier, don't be shy about letting us know what your interests are, and both geographically and in terms of types of investment buckets and vehicles and impacts that you want to have. And because we do want to connect you with others who can help you find information and just work together to build out the field and learn together. So I guess unless there are other comments, other questions, Janice, thank you very much. Thank you everybody for joining us. I hope we'll see you on more NC3 webinars in the weeks and months ahead. Again, any questions, comments, don't hesitate to reach out. Thanks everybody. Bye now.
Thanks, Ken.
Thank you, Janice.